because we've seen so much transformation and impact in this sector. We're now over the weekend witnessing the launch of a whole new row of F&B outlets at J1. A huge amount of investment into that area in Dubai, and it's a sector that continues to attract interest and investment from all of us. Before we get started on the topics of the panel, I did want to go through with each of you, because you each have very different backgrounds for achieving some of the similar successes and outcomes across your brands. The discussion today is really going to be focused on the institutionalization of this asset class, the investment interest that has been attracted into the space, and wanted to go through each of you, and if you could share a little bit about yourselves, about your brands, and about some of the deals that you've been involved in, or the approaches that you've taken in financing the growth of your own organizations. So if we could just maybe start with Ajaz and then come down.
Good afternoon, everybody, and thank you, Zach, for having us. So by trade, I'm a hotelier who, by chance, got the opportunity to come and open up Zuma Dubai, after which I moved to head office and help with the expansion of the brand globally. Then you talk about deals and real estate. So we were lucky enough to, by the success of obviously of London and then of Zuma Dubai, that the brand was quite in demand. And then we had real estate operators and owners globally reaching out to us, sometimes willing to pay for the whole project. Other times giving us a sweetheart deal, just so that we would become the, like say, the anchor tenant. And fast forward many years, and I moved from Zuma to open up the Arts Club in Dubai back in 2018, and I think we were one of the first, and still are the largest, or could be the largest tenant in ICD Brookfield Place. I wish we'd cut a better sweetheart deal, but here we are. Who knew? And I think if you ask ICD Brookfield to the value that the Arts Club has brought to the building and the real estate, I think the proof is in the pudding. They sold 50% of it. So I think great brands have the opportunity to certainly add value to any real estate portfolio. I can talk about other deals, but yeah.
Yes, Sanjay, would love to hear not only about what you're doing now at ADMO, but your past life. You recently executed a transaction that I think has been a notable one for the industry, somewhat of a benchmark. So if you wouldn't mind sharing a little bit about not only your current life, but your previous life.
Yes, I think we've all got to live with these high valuations now that have been set, especially now on the buy side, makes it more complicated. I feel like in hospitality, it's an industry that I love, but I seem to have covered it from different aspects. On the financial side, investment banking, and whilst I private equity, also invested in hospitality assets. Since then, I have operated, owned, and now managed as well. So I have a sort of wider view on some of these matters, both on the buy side and on the sell side. But it is a fantastic industry to be involved in, as I'm sure most of you agree. Talking about the recent transaction, we had a family-run business that had been in existence for, let's say, 40 years, and we transformed that business, we sort of institutionalized that business, based in Spain, institutionalized that business, took it around the world. Doubled the margins, looked after those aspects that investors typically care for. So we had stabilized sort of cash flows, high margin, expansion around the world. Cash was no longer, the mode of payment. Brought in ESG and hence managed to, get a good result for the shareholders. So I think it's been a great sort of case study. for essentially a nightclub brand that had been around for 40 odd years, so now 50, 51, and a long may it continue.
Antonio, would love to hear again about your journey at Sunset Hospitality and some of your experiences in working with investors. You've worked with some notable investors in the Middle East on various transactions. So, if without further ado, over to you.
Yeah. So I think our case is a bit different because we've been a bit of a Cinderella story from Dubai perspective. We started a business here almost 15 years ago and been growing organically since then. Today we have over 80 venues in 22 countries, and we have another 30 new venues that will be open over the next 12 months. So quite a fantastic growth and a fantastic story for the industry in Dubai, which before we go back 15, 20 years, we were receiving brands, we were receiving international concept to land here in Dubai, and now it's the other way around. We are actually expanding our concept all around the world. And this is the testimony of the fantastic work that both the whole sector has done in Dubai, but also the support of the government with initiatives directed to drive tourism and have the right infrastructure in place to provide the services we do. In our case, the journey being an entrepreneur and starting with a very small startup setup here to what we are today, it happened over 15 years. So it hasn't been one day changing from the other. But I would say that from the early beginning, we had the goal of growth and expansion. We didn't know how, or we didn't know exactly how we were going to do it. And organically, that materialized. The change really materialized together with Dubai. Dubai being globally accepted as a mature city, as a mature destination for investment, as one of the global capitals of the world, kind of help us to attract the right scope of investors. In our case, in 2022, we have Goldman Sachs investing with us. We are right now in the middle of another process for further expansion. And now we are actually playing the other role. Ourselves, we are buying other business. This summer, we bought a company out of Hong Kong with another 20 restaurants that we have added in our portfolio. And we are actively looking at another 6, 7 deals that we hope to materialize over the next few years.
Ajaz, when we were planning for and preparing for this panel, we discussed the conflict or the challenge in the institutionalization of the F&B sector, that there's a je ne sais quoi that the sector has, that brands have, that sometimes comes into conflict with the interests of investors, and particularly the likes of private equity. Now, your organizations that you've led have been, despite overwhelming interest from investors to participate, have been very conscious and selective and have been largely self-funded. So would love to hear your thoughts about the risks that you have or the pressures that you avoid by focusing on working with shareholders that understand the long-term value creation of brand, and why you've leaned towards this approach of not working with a large number of investors.
Sure. I think we've been very fortunate that when we created, we started with the Zuma brand, back in 2001, I think, in London. And for those of you who don't know the story, Arjun Wani, our chairman, was getting frustrated by not getting bookings at Nobu. So he decided to make his own brand, and here's the story of Zuma. He actually met the chef, Rainer Becker, at his barber shop. That's how they got connected. And I think fundamentally what was important for us initially, again, like Antonio was saying, you don't have a growth plan, you don't know exactly what you want to do. It was just supposed to be one restaurant. And then because there was a family member in Hong Kong, they opened up another restaurant. Dubai was the third or fourth place because there was a family member in Dubai. I don't think anybody had the crystal ball back in those days to understand or to realize where Dubai is today or where it's headed. And I think throughout the years, we've only cared about the brand. And the business, we've had board meetings where we would never, I think the idea always was don't make up numbers at a board meeting to please the board. As long as we were doing better than last year, I think that was that's all we needed to focus on. And even in our management style, to be honest, I used to tell my team, don't worry about the P&Ls. P&Ls are my problem. You worry about the customer. And I think that's so that's how we've always ran the business, even till today, to be honest, even at the Arts Club. And then, of course, we've had sovereign wealth funds, private equity firms. I mean, you name it. Everybody's, wanting to either buy us outright or put money into the business. Even at silly multipliers that at once when we were testing what it could be. But in the end, I think back in 2012 or 13, I have to get my years right, probably 12 or 13, we sold of Azumi Group back in the day, 50.01% to Dorsch, which is a Turkish conglomerate run by this gentleman, Sheikh. And I think the only reason why we did that was because, look, you also have to take something back after a few years of investing in any business. And Sheikh and Arjun Wani's thought process on how to build brands and not to squeeze every penny out of them, and it was not a 7-year investment cycle. I think that was our partnership, and that's where we are today with them still.
Sanjay, we've touched upon a few times multiples, and as we mentioned earlier, your transaction set a bit of a benchmark for the industry, being recent and being sizable. Can you tell us a little bit about how multiples have changed in the F&B business, particularly again in this segment, the high-end luxury F&B, which has historically had very different multiples from these mass consumer F&B brands, which trade at very, very high levels. There's been catching up in recent years. It used to be an industry that traded in the low, mid single digits, then creeped into the double digits, now trading into the teens. So we'd love to hear your thoughts, having and actually your previous life, even as an investment banker and Lehman Brothers covering the sector, how multiples have evolved in the high-end hospitality brand, and what you think the drivers are of that.
Yeah, actually, it's probably related to something that Ajaz was talking about, or your previous question. That I do think that that investors have over time educated themselves as to how this industry is different, and so there's been a move on their part to better understand what makes this industry special, and at the same time, the industry has moved and evolved. In talking about some of the things that I mentioned earlier in terms of how the businesses are managed, how people now find careers in this industry, how there is succession management, how there's professionalization across the board, how brands remain invested in and are sort of long-term value generators. And so I think there's been a shift both on the investor side as well as on the operator side that allows for these higher multiples. Of course, multiples don't exist in isolation. So you have to, it's tested against, like, a good deal is only a good deal at the once you've sold, perhaps, right, from an investor's point of view, not when you go in. And so the ability for these businesses to stabilize cash flows with Antonio's amazing platform, for example, being able to balance seasonal businesses versus non-seasonal businesses, different parts of the world, different cuisines, different, whether it's management agreements versus leases versus license agreements, etc. That shows and that provides investors with that level of comfort. And then to add on ESG, which probably lowers sort of the asking rate of the investor coming in. So I think all those points put together has meant that there's been a shift. I mean, when I started my investment banking career, I was selling pubs at 7 times on an opco basis. It was with the propco, it's probably more expensive, but 6-7 times. Nightclubs at 6 times, and now I think it's a lot higher, as you say, mid-teens.
So Antonio, with higher valuation multiples, How has that enabled operators and organizations like yourself to make equity more attractive and to opened up more avenues for growing your business through equity raises and financing structures? And how do you think about doing those at group level versus asset level?
Yeah, I think the focus is on the group level. I think anything that is at a OpCo on a lower level is very transactional, more tactical. And one thing that we've seen, and I think has been consistent over the last 20, 25 years, is I think, and I have to make a note here, we have to separate when we talk about F&B, the more traditional, casual, transactional F&B, which have been mature for many years. You know, you start with the QSR all the way to the casual brands. And there is another kind of sector, which is where the three of us are operating, which is more of the lifestyle, hospitality, lifestyle F&B. This lifestyle F&B is relatively new. Most of the brands are 20, 25 years, 30 years. You don't find that longevity on historical brands, you know. And what I think has happened over the last 25, 30 years is we have somehow broken this glass ceiling that we have in terms of size. Part of that is driven by globalization, brands like Zuma, which is now recognized all around the world. And Pacha was another great example, something that we're trying also to build all around the world. And that this platform of lifestyle hospitality are relatively new, if you think about it. So that is, I think, one of the reasons why we haven't seen much historically, and now there is a bit of a hype, because now the businesses have the right size, they have the right professionals behind, and they're getting that institutionalization where there is the right corporate governance, you have a right financial structure, and you have the capacity to make a business durable and sustainable over a long period of time. So in our case, when we look at our long-term operation, is to think about how we can become a global business that is durable and is sustainable over a period of time. And that ultimately is what attracts the institutional investors, can have a good equity story, or ultimately even a public story.
And I think you're driving to the heart of the issue and the heart of what has really changed and driven valuations is the scalability of brands, the ability to take a brand and to take advantage of scale. And again, if we look at the differences, I referred to the mass consumer F&B, the industry that trades in the 20s and 30s and sometimes even higher multiples, because again, you have a brand like Chipotle that you can copy, paste, and wash, rinse, and repeat with a mass number of consumers. But what I think has transitioned in recent years is the ability to scale brands within the high-end lifestyle F&B segment that you refer to. And I think, Ajaz, you have been a master of brand and being able to take those brands into new markets. Now, the ultimate kind of lever for scaling F&B tends to come from taking more advantage of licensing and franchising, but that's been a part of the model that you've been very skeptical of. So would love to hear your thoughts on,
it goes back to control and controlling your own brand. And in our life cycle, and I go back to my Zuma days, in the life cycle of Zuma, we also saw brands such as Nobu and Hakkasan that made mistakes by franchising or giving management contracts, to the fact that when you go to those restaurants, they're serving breakfast there in the morning, and then you have a lunch service, and then and then it if you ask me, it actually damages the brand a lot. So we decided not to do that. The only thing we ever did was certain pop-ups, which we controlled, but they were in certain locations to test the waters. And we realized that the pop-ups is a great way to, one, test the waters, and two, make sure your payroll over slow periods is looked after, because you can actually charge the third-party company for the payroll. But I think, once again, to go back to brands, and Antonio, you're right. In the last 30 years, I think restaurant brands, F&B, have become lifestyle, and they're becoming trophy assets. And we are much cheaper than a Formula One team or a football team. So, to invest money in a brand, let's say Zuma or Arts Club or anything like that, it's a lot cheaper to actually do. And the scalability of it is enormous. And I take Nobu as an example again. Nobu started out as a restaurants, and now it's a hotel, and I don't know, residence, and blah, blah, blah. So the multiplier keeps changing because the brand has such flexibility. And, could other brands do the same thing? Of course they can. Probably some, can we start making Mercedes cars tomorrow or cars? No, but we will stick to what we do best. I mean, we do hotels right now. We have a private members club, which seems to be pretty hot at present. I think everybody and everybody wants to get into the market. I mean, we're a 160-year-old brand that we took over back in, again with the dates, I think it's 2000 and 2018, 2019, I think something like, no. Anyway, whatever, it's 20 years ago. And we've been running this brand. We've only opened one more since the London inception, since we took over London, because it's actually not easy to multiply a private members club the way we can multiply restaurants. You have to know the market, you have to know the city. Can they afford the membership concept? Will they understand it? The size and the scale of this place. I mean, Dubai is 65,000 square foot, 67 because we ran out of office space, so we had to rent an ICD. So these are 3 to 5 year projects, whereas a restaurant, if you're a well-oiled machine, you can open 2 to 3, to be honest, in 18 months and in multiple cities. So, I mean, yeah, that made any sense.
Speaking of opening restaurants at pace, we're seeing and maybe dialing into the Dubai market, we're seeing quite a pace of restaurant openings in Dubai in recent years. And just in, as I mentioned earlier, we've got a large number of openings happening in recent weeks and in the coming weeks. So Sanjay and Antonio, if I could come to you with some final remarks. It looks like we're just running out of time, about how you see the Dubai market, how you see competition in the Dubai market, not only the competition for customers, but the competition for talent, and whether you think there might be, weighing the risks and the opportunities in this market with the wave of openings that's happening.
Yeah, I think I'd leave the Dubai specific to Antonio, given that I moved to the region 6 months ago. But I have to say that I make a few other points before. I think that one of the, with a lot of respect for what Zuma has managed, I think one of the most risky things that owners, operators of restaurants can do is to believe that a successful brand in your home market can easily be opened elsewhere. So moving brands outside of geography where it started is fraught with risk. I mean, it is, you need to have infrastructure to plug into. You need to have the know-how, either a local partner or through real estate or an operator. And if I spend 30 seconds on it, and that's what sort of we're doing at ADMO, right? We're taking brands and bringing them to the region, allowing them to plug into our infrastructure so that we can grow them here. And likewise, when we have brands based here in Dubai who haven't been to, or who don't have venues in London or in Miami or in Las Vegas, we plug them into our infrastructure there, because that takes care of a large amount of the risk, and where then the brand owners can just focus on the front of house, the design, the product, the brand, etc., and everything else sort of we can take care of. So, whilst I'm delighted that our brand's coming here, it's still fraught with risk, which needs to be taken into account and understood by investors, that you can't simply just roll out, notwithstanding what Zuma managed to do.
No, I mean, but you're right. You see, and I think Antonio made that point some time ago. People can buy brands, throw money at it, import everything, but if you don't have the right operator who can actually run the business for you, you're just wasting your money. I think that's, and we've seen time and time again the same pattern in Dubai and Abu Dhabi, and not just even in London right now, it's the same thing, or New York. If you don't have the right operator, they're going to basically burn your money. So I mean, that's all I'm going to say.
Yeah, totally agree with that. One of the things that people don't realize on the business, assets are important, brands are important, the concept, the location, but I think the number one factor that drives success is the people, is the team running the business. And it's more of a talent kind of fight rather than a location fight. And I think, back to your question about Dubai, one of the things that we are privileged here is the capacity to attract talent in Dubai. And that's one of the engines that drive the hospitality offering, the capacity to get talent from around the world, because there almost no limitation in terms of visa generation from any nationality. They pay well and provide a city where people want to live. If we compare this to other destinations in the world where we operate, it's much, much more difficult. So this creates a competitive advantage. And I think locations are great because we have fantastic real estate development. So every now and then you have a great projects like the IFC when it came together 20 years ago. Now you have La Mer, you have the Palm. So there's always new real estate that create new opportunities to provide that experience. But I think the number one factor that differentiates the city is the capacity to have that talent, to grow it, and to retain it here.
Well, I think that's all the time we have. I'm sorry that we aren't able to take any questions. I have about 3.5 pages worth of questions that I wasn't able to get to, but it really is an honor and a privilege to have had you here. It's incredibly impressive what you've built in your portfolios, and hopefully one of these days you'll allow me to invest as well.
Thank you, Zach.
Thank you.